Hello, welcome to the Closing Beat, everybody. How are we doing today? Happy Thursday to you. Hope you had a good day here so far, and if you hadn't had a good day, maybe the market's cheered you up a little bit. We've got a lot to talk about in that respect today. That's what we do here. We're financial advisors that just like talking about the stock market because we're in tune with that. We're paying attention to it. We don't just go and disappear all day and tell you it's going to be fine. You just keep investing. We don't like that. We like to add value where we can, so much so that our business model, if your account doesn't grow, then we don't grow as a company. Simple as that. That was the number one thing that I set out to do so many years ago when I had more hair and looked a little younger. Well, anyways, let's move on. Hey, if you want something free, jazzwealth.com/2023, send an email to Haley. She will send you out all of the 2023 numbers for you at no strings attached or anything. You know the drill. We won't sell your email or do anything. We're just happy you're paying attention, so we wouldn't dare do that to you. Also, a special thank you to Britt. Britt came by and dropped off a VIP Disney tour pin from Disney. Obviously knows that I'm a fan there. That is super, super cool. I thought that was very, very cool. So that will be going up. Probably just pin it to the backdrop there. And also Randy had sent in some records here. Dave Grusin. You guys know how old Dave Grusin is? He's still out there kicking. Original records here by him. Love it. And so you can't see it, but up there in the top, we actually have a record player that hooks up to a USB. Super cool. Looking forward to playing that along with some big band stuff as well. So if it makes it on the show, you may hear it. You know, we get the demonetization or whatever, but so be it. Let's get into the good stuff. You guys know how you tell me. I see the comments every now and then. And by the way, we can't reply to a lot of the comments because if it would seem like we're giving advice, then we get in trouble. So if you want to say something like, hey, your hair was a mess today or something, all right, we can go back and forth on that. But if you're asking for advice, things like that, we'd get in trouble if we responded. We can't even give you a thumbs up. That is because we are SEC registered. So we're like the big fish. We're not a big fish, but we're in their pond. So we have to play by their rules. But you tell me sometimes, and I see the comments there about, you can't use historical stats, man. You can't use that. Okay, I would agree that you wouldn't want to use that to make future predictions. You could use that to tell whether the tide may be shifting in your favor or not. And you can also use it to tell that humans are just normal people. We behave in patterns, and like it or not, those patterns pop themselves out. We talked about when, I've given you so many stats over the years, but we've talked about different scenarios where when interest rates do certain things, the markets tend to do this within 3 months, 6 months, and a year. You've seen all that stuff. We're going to go over the inversion of the yield curve today. We'll do that again. And these things just happen sort of on schedule because we behave on schedule. We're creatures of habit, right? Well, I say that because it was exactly 15 years ago today, this very day, I don't know how far back you go, but 15 years ago today, Bear Stearns, it was the 5th largest investment bank on the planet, it was due to go bankrupt on this very day, 15 years ago. And JP Morgan swooped in and bought them for $2 a share. Right? Don't you wish you had a couple bucks? You could go back in time and do that. That turned out to be a weird investment for them, but they did that. That was 15 years ago today. Isn't that weird that we literally are solving for the same issues? The comments that the Fed made, Ben Bernanke back in the day saying, we're working with the Treasury, we're working with the government, we're working with ourselves, the Fed, to make sure we continue to provide liquidity to the financial markets, because that's obviously a major factor of our growth. Those same comments could be made today. Fascinating how that works. But now that we're dealing with SVB and Credit Suisse and FRC and all this stuff, isn't that weird? So are we on the brink of some kind of financial issue there, or is this something we won't even talk about? A year from now, we'll be just fighting over politics again, right? Or not. What will it be? We'll see. I don't know. I'm not telling you I know the answer, but I'll tell you that the markets think that this is just a temporary little bump in the road, and here's why. The S&P is responding to support. We just talked about this yesterday, that the markets want to and desperately are trying to use this as support. Today, they found those additional buyers and were able to move us away from that. The more you move away from that, the more you convince people that this is support right here. This is something we can use to hang our hat on or be positive or bullish for a change. The S&P gains 1.8% today. Huge day. That's half of the year-to-date gains. Literally, from yesterday to today was a 100% increase in its year-to-date gains. So that's kind of a funny way to say it, but it gives you an idea how big the move was. The real big move came in the NASDAQ and has continued to come in the NASDAQ because what moves markets higher? Well, 5 to 10 stocks, really. That's about all it does. The NASDAQ's almost back to highs there, and for the year, it's up 15% year to date. You'd never guess based on all the drama that you see, but thanks to names like Microsoft getting back to new highs there, Alphabet, there we go. Back to the 200-day moving average. Meta getting all excited because, well, hey, we're going to ban TikTok. That's good for Meta. So you got that going on. You got Amazon last place, but still starting to see the strength. And of course, there's Apple. Those, you got to include all of those. Apple hinting at possibly a little bit of a sloppy, but nonetheless breakout above the 200-day moving average, and all the semiconductor stocks. So you got NVIDIA, Broadcom, Intel, AMD, Qualcomm, On Semiconductor. Yeah, go through them all. They all had a great day today. You could even just use the ETF, the SMH, to see the performance of all of them in one shot. So you have a market that's being led by those stocks, but normally I would give that a little bit of grief and I would say, oh, that's not fair, just those stocks moving it higher. But that's not actually the case today. It was broad market buying. Granted, yeah, I was led by tech, so we'll use the ETFs here in the S&P. We'll use the sector ETFs to do it. You got tech leading the way, communication services, both of those up 2%. You got financials in a very close third place. Financials almost up 2%, very oversold sort of rally. We talked yesterday about how, and we're going to cover that tonight in our Wine and Wealth, but yesterday we talked about we, as a company, selectively added to our financial positions. You have to. We just, like, that just makes perfect sense. It was perfect timing. We wanted to use some of our cash. Well, that has paid off so far very well. It could all be erased tomorrow, don't get me wrong, but for the moment, I'm going to wear my celebration hat, so you guys can just deal with me. Consumer discretionary, let's go back over here. One of the weaker areas so far, but still kicking and participating. So that shows that it's not just a tech rally. Energy, oversold bounce here. Healthcare, which has been a bit of a laggard, oversold bounce there. All those sectors that had been oversold, like utilities, finally starting to give you a little bounce. You even have the Jazz Wealth play. See the W? Hey, that's exactly. Real estate was the lagger. So if anything, well, it was an off day for real estate. It was basically flat. But all in all, you got a great recipe for support. There you go. In this area. And it's a known, very much focused on area that people like to look at for making their timing decisions. So whether you agree with timing the market or not, people say, that's my location. I'm going to give it a shot here. Right or wrong, I'm in, going to give it a shot. So that's what you saw today. The Dow gets all the attention because it's the bigger number and it looks more impressive. Up 400 points basically for the day. It is still negative year to date, though. That is the only index now that is down year to date. It's down about 2%. Not a big deal. The Russell 2000's gains today put it back into positive territory by about 1%. Small caps most definitely participating. However, your action today was in large cap value, large cap index, large cap growth. Very close second, small cap value, small cap index, small cap growth. So mid caps played along today, but if there was a sign of something that maybe just didn't quite go as much as you'd hoped, well, that would be one of them there. Other than that, let's take a look around here. You got oil trying to recover off of its lows. Energy obviously participating with that here today. And bonds taking a break from their way above average move. We talked about that yesterday using the SHY if you want to know more details. Gold pulling back ever so slightly. That's not even really a big deal today. Obviously a big move for gold there. And so where do we stand now? Let's take a look. So we've got year-to-date changes here by sector in case you want to look. We mentioned a minute ago healthcare being one of the underperformers. You can now kind of see who's underperforming relative to the S&P. This is as of yesterday, being up 1.37%. You've got energy, financials, utilities, healthcare, consumer staples, weirdly enough, basic materials and industrials really underperforming everything with all the action happening over in tech, communication services, and consumer discretionary. The very sectors that are the economy is doing just fine sectors. Everything is fine. We're growing and there's no problems at all. I would like to go invest in those sectors. That's what happens. Those are the cyclical sectors. the sort of neutrally cyclical, I don't know what the word is, like utilities, like healthcare, sometimes like energy, consumer staples especially. Nobody wants any part of them. And I'll continue to mention, how weird is that? We're supposed to be going into a recession. We're maybe even in one right now, but nobody wants a part of that. Isn't that interesting? So you could either be one, counter trend and say, I'm not buying into this tech stuff. That's a mess. It's going to continue to be a mess. You could avoid that, and you could be over in consumer staples and real estate and healthcare and say, I want safety. I want my dividends. I want to focus on that. By the way, our Jazz After Dark coming up here is going to be on the percentage of returns that you actually get from dividends, like it or not. I'm going to go through a really, really geeky kind of a thing. So I'll go through that. Side topic. But you could either look at being a contrarian or simply just ride the wave, right? If we take another step further here, you could see as compared to year-to-date performance, who's kicking butt here? What's happening? So over the last 5 days, utilities. Wait a minute. That was one of the underperforming sectors right there. People buying the discounts in utilities, probably due to rates, but still they're buying the discounts in utilities. Let's look over here. Communication services, consumer staples. Oh, well, not these guys, but these guys, consumer staples. Where were they? Oh, right here. One of the weak ones. People going and looking for a little bit of that safety. So if there was a slight black eye on all of this, that may be what we have, but so far, not a big deal. And I think it's cool to be able to share that with you guys. Back to bonds here for a minute. The 2 years versus the 10-year remains inverted. I've covered this a bunch. You know what that is. You know why that is. However, we previously have said, hey, when that 2s versus 10 is inverted, you get a recession. However, I thought it'd be fun to go a little bit further and say, how long until the recession? You know, I've showed you all the charts. We've done plenty of classes on this where we show literally the inversion leads to a recession. The inversion leads to a recession. It's 100% of the time. It's the only stat that I know of that happens 100% of the time. So let's take a little bit deeper look. When the 2s and 10s invert by more than 0.5%, which we have, how often do we have a recession within 6 months? 62% of the time. So it's not that we invert and we go into a recession. 6 months. Let's look a little bit further. How often does it happen? In 9 to 12 months. 90% of the time when we're inverted by more than 0.5%, which is almost every time. There's been little blips that didn't do that, but 90% of the time. So it's not right away. How far along are we since we started the inversion? How far along are we? Right? 90% odds. And anytime the yield curve inverts, within 15 to 18 months, you do have a recession 100% of the time. So I wanted to do that, and it's kind of quickly going through it, but I wanted to share that with you because, whoa, it does happen, but why is it not happening? These things take time. We have a yield curve inverting. We have that time for that panic to set in. Granted, it's faster these days than it used to be, but we have that time to set in. We have time for rates to go up. We have time for people to pull back their spending. This doesn't happen all in one night, but it's fascinating to see that if we do not have a recession pretty soon, then that would be the first time ever in history that that's happened. That's pretty cool. Anyways, our Jazz After Dark, we've got a couple good ones here. Tonight, we're going to do a lesson on what does it mean when banks hoard money? We know what it could mean when a Caterpillar decides we're going to hold on to our cash. We've gone over that. We know what it means when NVIDIA or Intel or AMAT or Apple says we're going to hold on to some cash. We're not sure about the economy. We're just going to do it here. But there's a real big difference when banks do that. So we're going to go over tonight what that means and specifically how that business operates when they decide to hold cash because, fear of maybe people taking out all their money. We've got two great Jazz After Darks coming up here. We're going to do the geeky statistics. I'm going to try to do it all on one simple picture where we're going to talk about you using puts as a hedge. Complete waste of money unless you are absolutely perfect in your timing. So, and I've always kind of mentioned, don't use puts as a hedge, use cash as a hedge. Why pay for insurance if you don't have to? Just hedge your portfolio by moving to cash. And so I'm going to actually show the data that we use to determine that and put the odds in our client's favor. I'll just share it with you, and hopefully I can get it all sort of cleanly figured out there. That's one of them. The other one is, what percentage of your investments over the long run actually come from dividends and not from returns? We're going to talk about each index. We're going to talk about each sector of the market and show you how the total returns of a sector, there are 4 sectors where the majority of your returns actually come from the dividend. So if you pulled out your dividends, you would have a greatly lowered return by just simply hoping for growth, and we'll go through all of them there. So had a little spare time. We got some geekiness coming your way there. Hope you will join us for it. Remember tomorrow we have the S&P changing their some of the stocks that go in different sectors. I did a class on this already, the Jazz After Dark. You can check it out there. It is titled, I believe, Mutual Funds, ETFs, and Retirement Accounts Changing on March 17th. Something to that effect there. Let's go over to stocks in the news for the day. Shall we? We shall. Once I learn how to type. Hey, there we go. Adobe back to the 200-day moving average. Better than expected earnings, raise their guidance going forward. They're not feeling the sting of everything going on just yet. They were a little bit cautious, but not enough to cause any real pain there. Remember, they're one of the tech stocks that would deserve to underperform if we, in fact, did slow down. You can imagine they have their hands in everything now with all their purchases that they've done. And so they said, not so bad. We actually are going to, we actually are going to raise our guidance and tell Wall Street, hey, expect a little bit more out of us. Credit Suisse in the news, they get, what was it, $50-something billion there from the Swiss National Bank. That helped the European markets overnight, at least kept them positive anyways, much different from what we saw yesterday. Snapchat, Meta, and the others all up on the day because the Biden administration is now saying, okay, maybe Trump didn't have it too far off there. Maybe we should ban TikTok. I don't really take political sides on that. I do wonder why we don't see specifics. Okay, we're going to ban something. That's a little bit odd to do that in the U.S. We're going to ban you from doing business. Not common, right? But then they don't really give any specific examples. Oh, we're worried about your data. I'm going to need more than that. What's going on that you would do that? We ban them from Congress. All right, I get maybe a security issue there. But you notice how they never really specifically say, this is the information we've come across, even generally, just to kind of, maybe not give away proprietary stuff, but they say, oh, we just don't like it. We don't like it because we worry about your data being housed somewhere else. Didn't they already say we were willing to accomplish that by working with Microsoft and make it so that the data is not questionable? What's going on there? I find that to be a little bit odd, but hey, nonetheless, that's doesn't matter what I think. We have the other social media stocks obviously going higher. And how often have you heard of Snap being in the news? So they could use it. I bet you they're cheering that ban on. First Republic National Bank, First Republic Bank, I believe, gets a little sigh of relief here. Morgan Stanley, Goldman Sachs, Citigroup, JP Morgan, Truist, PNC, and a few others said, we actually got a lot of your money because people pulled out of your bank and they put it in our bank and we're bigger. We're just going to give it back. So they're kind of forcing you back into working with First Republic Bank. That's a very oversimplified way of saying it, but I thought that was funny. A little bit of team sports there. I don't know what that's going to cost them yet. I was talking to a few clients about that. That may turn out to be quite costly for them, but nonetheless, they're like, here, there you go. We'll each give you a few billion and put you back in the right place. Lastly, Signet Jewelers comes out with their earnings there. Sales were as expected. Earnings not too bad there. Weren't very optimistic going forward, but they can afford to do that. Their margins on this garbage is ridiculous, right? If you're going to go buy a diamond that nobody really knows if that's a real diamond or not, your friends and stuff. Obviously, they can't sell fake diamonds. But yeah, they're going to sell it to you 7,000% markup. Okay, you can afford to have lower sales. You can afford to have a slower period there because you guys spend so much money on that stuff. You see me with my gold chains and stuff, right? So I like the diamonds. I like the gold. I spend a lot of money on that. No, I don't. Okay, so we've got some changes in the S&P 500, S&P 400, S&P 600. And what happened? Why is that happening now? Anybody know? Because just like, where's Warren Buffett? Why isn't he on TV every day? Normally he's on TV quite a bit. Why is everything okay? Why is he not on TV? He's shopping. He's out there going, okay, we got my discount here. He buys when things fall. Notice that. That's a common theme. Whenever something is going really poorly, Warren Buffett is not on TV. He's working. He's putting his money to work. But when things are calm and everything's up, hey, yeah, I'm available for an interview. Think about it that way. When Warren Buffett shuts up, and so do all the other big guys, when they shut up and go to work, you probably should too, right? Seemed like a good time to do that. All right, we got a busy night here tonight. I'll take your questions for a moment, but we have Jazz After Dark coming up at 7 o'clock. You join us for that, hopefully. And then we have Wine and Wealth coming up at 8 o'clock for clients. We're going to talk about the positions we have bought. We're going to talk about why, and we're going to go over some of the other ones that you may want to be concerned about, and specifically why. We'll focus on all of that. And let me see if I can do this here. We'll try to and talk about it. What if Biden publicly came out and agreed with Trump? Yeah, that wouldn't be too bad these days, would it? If every now and then one side would just say, we disagree from time to time, most of the time, but we agree with you on this one. We're going to work together on this. Could you imagine what that would do in this country if 1 out of 10 things they said, we're going to keep fighting you on, I don't know, guns and abortion and all the things we just can't settle. We're going to fight you on that, but you know what? We got your back on this one. We want to build a better airport system or whatever it is they agree on. I think that would do really well for those people. Yeah, my thoughts anyways. And maybe somebody figures that out, and the first candidate that actually does that gets a lot of support because we can all go, hey, we do disagree on some things, but doesn't mean we have to be crappy about it. Yeah, doesn't really happen much anymore, but you buying your credit suites. I know there's a lot of you out there doing that. I just because you had, what was it, GameStop and AMC, right? I know you guys, you see something follow. Hertz was one of them. That one actually turned out okay. That's funny. Tom says, there's also any opinions why Visa XP underperform XP, but they're very good. There's some changes happening there. So it could be pressure from the big sector ETFs getting a head start on changes. That's a long shot, but it could be. You never know. Could be. Yeah. I love it. Well, I will wrap it up early because we've got a busy night tonight. Jazz After Dark if you want to learn more about the banks, and of course Wine and Wealth if you want to learn about the positions we just bought and why. We will talk about that, show the performance and everything so you can see where we stand. If you're one of our clients, of course, that's a cool update. Not our most popular class, by the way. I haven't done that in a while because it's not the most popular, but I'm going to do it anyways. So you guys can come and check that out if you'd like. And of course, I'll stick around and answer questions as long as people have them later. And that's it. I'll see you later. Thanks for watching. Enjoy.